How should you buy a home in your 20s? It's exciting. This is Ken Van Liew, Modern Wealth Building Formula author, How to Master Real Estate Investing. Today I'm going to show you how to buy a house in your 20s. Let's get started. Curious how to buy a house in your 20s? If you are dubious, it can be done. We get it. Between entry-level salaries, college loans, and the desire to just be young and have fun, 20-somethings often think buying real estate is beyond their reach. No so. It's entirely possible to buy a home in your 20s and become the first-time home buyer, and it will benefit you big time down the road. Here's how you can make your home buying dreams come true much sooner than you think. So let's look at how to buy a house in your 20s. Number one, save for a down payment. Being a homeowner with a mortgage is not renting. To afford to buy a house at your age, you better have some cash saved for that down payment. A lot of cash, actually. Most financial planners recommend that first-time buyers make the down payment of 20% of the price of the home. So if your typical $250,000 house, that would be $50,000. Ouch! Granted that you don't have to put down 20%, but doing so enables you to avoid paying private mortgage insurance, a premium that can increase your monthly payment up to 1.15%. So if you don't have a ton of money in savings, one way to avoid the down payment is to ask mom and dad for financial help. Another option to afford a down payment is to apply for down payment assistance, believe it or not. Depending on your income and other factors, you can actually qualify for one of over 2,200 down payment assistance programs nationwide, which helps out first-time home buyers with low-interest loans, grants, and tax credits. Definitely take advantage of that. So how much money are we talking about? Well, one study found that buyers who use down payment assistance programs save an average of $17,766. Sadly, most consumers aren't even aware of these programs or assume they are too difficult to qualify for. Don't be one of them, please. Along with the down payment, home ownership will require you to pay monthly mortgage property tax and homeowner's insurance. In many cases, sellers usually take care of closing costs for real estate transactions. So the first thing you want to do is you want to shore up your student loan debt if you're in college, right? Student loan debt has surged to an average of almost $29,000 per borrower, according to the Institute of College Access and Success magazine. But college debt doesn't automatically prevent you from becoming a homeowner. Most mortgage lenders require a borrower's debt-to-income ratio, how much money you have owed divided by your income, to be more than 36%. So someone making $6,000 a month and paying $500 a month in a student loan debt would be able to afford a maximum monthly mortgage payment of $1,680 in many markets, and that's plenty to buy real estate. So if you're stuck with student loan debt, don't worry about it. Keep thinking and asking yourself questions. One way to make room for a mortgage is to refinance and extend the life of your college loan. This results in smaller monthly payments over a longer period of time, so you'll have more you can put towards your mortgage. The caveat is that you'll end up paying more in interest over the life of your college loan, but it means you get to become a homeowner. And in turn, you take advantage of low mortgage and interest rates. And this is represented by many loan officers. Moreover, nearly half of the states today offer housing assistance to college grads carrying student loan debt. For assistance, this is another New York's new graduate home ownership program is something that you should look into, which gives assistance for first-time home buyers. And for all you metropolitan area visitors, look into moving here. So if you need $15,000 down, you can get this, right? Now you can meet with a mortgage lender to find out if you qualify for one of these programs. Check your credit score out, of course. Unlike older generation, home buyers in their 20s tend to have shorter credit histories. That can be a problem, but there's ways to improve that. And since you have limited credit history, the odds are greater that you're going to have a mediocre credit score. This numerical representation, unfortunately, is how banks really look at lending mortgages. Mortgage lenders usually require borrowers to have a minimum credit score of 660. They also look at credit utilization ratio, your current debts divided by the credit limit on the sum of your accounts. For example, If you're carrying a $400 debt on your credit card and have a $1,000 credit limit, your credit utilization is 40%. Unfortunately, relatively new credit users tend to use higher credit utilization ratio. You'll want to get a free copy of your credit report and know where you stand before you get into this. And if your credit isn't up to par, you may have to take a few months and raise your score. Or you can have someone with a good credit score like your parents to co-sign for your loan and help you get started as a homeowner. So how to buy a house young? Purchase a starter home. As a first-time home buyer, you don't have to find a forever home right now. I tell young buyers all the time, this is your first home. It's not your last, right? Real estate agents have to understand that. In fact, there are a couple of big financial benefits to buying a starter home while you're in your 20s. First, your mortgage payments will probably be more affordable since you're likely to be buying a cheaper house. Second, you may be able to get a 5 or a 7-year adjustable rate mortgage and qualify you for a lower interest rate than you would be with a 30-year fixed rate mortgage, which would be a great decision to move forward, for your dream home, but not necessarily now. Talk to your real estate agent about buying a starter home and plan for the unexpected home expenses. All home buyers should have a rainy day fund to pay for that emergency income repair, such as a gas leak, as well as monthly mortgage payments a few months down the road. You're going to want closing costs, insurance, and property tax. And this is especially important for you young first-time home buyers. So why research how many millennials are less financially responsible in older generations? You can look at a study by American Trade that found more than 9 out of 10 millennials overspend and fall short on savings or take an additional debt at least once a month per year. Furthermore, a recent GoBankingRates.com survey found that 52% of millennials said that they feel pressure to keep up with their friends due to always going out constantly. You don't want to be buying at the top of your budget. You heard me talk about Rolex watches and all that kind of stuff. Well, unless you're buying new construction, you need an emergency fund for big repairs. So there's a lot of people saying, move over millennials, a new crop of home buyers is coming in, Gen Z. Young adults born after 1997 are poised to flood the housing market in this coming year because there's going to be some tremendous opportunities. And according to data collected by financial services company Morningstar in April 2020, 83% of 18 to 25-year-olds hope to purchase a home within the next 10 months. Another survey by mortgage loan company Freddie Mac found that members of the Gen Z also believe they're going to own a home by their 30, 3 years sooner than the current average home buyer average of 33. While buying a home young is not impossible, it does require some planning. So if you're interested in becoming a 20-something home buyer, there's several tips that we can give you, and that's why I started giving them today. But you can also look to decide where you want to buy a home. Real estate is all about location, 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 and presentation, presentation, presentation. How long do you plan to live in that home? Is there a possibility that you might move due to job change or marriage being in your 20s? Consider how easy and quickly you'd like to be able to resell that home if necessary. Even if you don't see the move as immediate future, think about what you want from that location. For example, do you want to be close to shopping and restaurants? Would you like to live in an area that's walkable and bike to places that you want to go to? Do you prefer the suburbs and the city? If your home isn't your dream location, you may want to move in the future another house hits the market. Buying a home in your 20s also means deciding what kind of property to buy. It could be a single family home, it could be a duplex or a condo, it could be a townhome, it could be a tiny home. Depending on the type, you have to pay additional fees such as homeowners association fees were normally for condos. You also need to think about how much work and money a home might require if it's not ready to move in. A fixer-upper could be yours for a bargain price, but you'll be likely to spend a lot of money trying to renovate it. A move-in ready home, on the other hand, may need zero updates, but could come in with a higher price tag. A house can often be seen as a long-term investment, but if there are short-term situations that could affect owning that home, like going back to school or eventually getting married, it might not make sense for you. So think about it. That's why make a plan before buying so you can move when needed to assess your financials. Assess your financials before you can move ahead with buying a house in your 20s. You'll need to give your finances a thorough review. Several things that can influence whether you can afford to buy a house is going to pop up once you review this, and you have to have a home that's reasonable for your budget. These items will also affect your mortgage approval process, which I mentioned to you, credit score, credit history, and these are the most important things that lenders consider when approving a mortgage. Your credit history tells lenders how responsible you are when it comes to managing your debt. I don't know if you know what FICO score is, but FICO credit scores are used by 90% of lenders. 4 members of the Gen Z had an average FICO score of 674 in the third quarter of 2020 when I did some research, and Experience, which analyzes consumer credit report over the course of 1 year. And this is where they will look for a 660 credit score or better, which can allow you to qualify for a mortgage in your 20s. It doesn't necessarily guarantee, but it will get you on track for those low interest rates, which is your goal. I didn't realize I've been rambling on for 15 darn minutes. Let's get this over, guys. 20 years old, get started. Check out kenvanliew.com. Subscribe for my YouTube channel and make it a great day.